The NAV has remained remarkably stable despite changing market conditions. What's been driving that resilience?
So I think it's infrastructure doing what we say it should have done. I think the fact is infrastructure is defensive, it's non-correlated, and therefore shouldn't be exposed to what's happening in the wider macro environment. And actually, if you look back since the 15 years since IPO, there's been quite a lot that's happened. If we go back to nationalisations concerns around PFI, COVID, geopolitical uncertainty, energy shocks, there's been quite a lot going on that should have impacted asset valuations, but in terms of infrastructure hasn't. I think that's particularly true for GCP. The nature of the assets we invest in have availability-based cash flows, so assets are paid based on whether or not they're available to be used, not how much they're used or if they're used. And I guess that's more demand-based economic infrastructure, such as ports or toll roads, that might be more exposed to economic growth or have more linkage to, say, GDP or economic performance. So a focus on availability-based assets has really helped GCP in terms of that defensive, non-correlated nature of ultimately the projects in which we invest. I think the fact that, again, we focus on debt rather than equity means we are less exposed to those day-to-day changes in revenues or valuations of projects. We have the equity buffer that insulates us from those changes.
Electricity price forecast continues to move around. How exposed is the portfolio to power prices, and how do you manage that risk?
You're absolutely right, electricity prices remain volatile, and I think increasingly are more volatile as the electricity system is made up of more intermittency, and I think as we expect demand to increase over the coming decade or so, driven by electrification of heat, transport, but also the digitalisation and demand from data centres and AI. GCP is exposed. We invest in electricity generation projects such as wind farms or solar projects or waste power stations. So therefore the revenues that those projects benefit from is a function of power price. We do try to hedge that in the short term by locking in fixed prices for the front 1, 2 or 3 years at the underlying asset level that fixes revenues over that time frame. But those assets are still exposed to long-dated views of where power prices will ultimately evolve. I think the other point we've often made on this in our disclosures is there is quite a wide difference between where long-term or consultants forecast the long-term power price. GCP uses the more conservative or the lower of 3 market forecasters to predict long-term power prices. I think there's less risk or a more conservative valuation bias in our portfolio than perhaps investors will find elsewhere. I think it's important to also recognise these are long-term investments and long-term assets, so short-term changes to power price expectations do even out over the longer time frame. We've seen some very high periods of power prices going back to 2021, 2022. We're still in elevated periods of power prices given the geopolitical certainty in the Middle East flowing through into gas prices and ultimately into power prices here in the UK. That all could change and it does remain volatile. I think the other aspect of power prices we're increasingly seeing is divergence between what a baseload generator, so a generator that's operating 24/7, benefits from versus, say, a wind farm that's only getting paid when the wind's blowing. And when the wind's blowing, all of the wind's blowing, which means there's lots of low marginal cost generation put onto the grid. So effectively wind and solar are cannibalising themselves because as deployment has grown over time. So the other dynamic I think we've seen over the last 10 years or so is an increasing divergence between baseload prices and the capture price, as we call it, for wind and solar projects, which is part of a diversified portfolio, again, I think is mitigated in GCP's portfolio across our various assets.
The portfolio has an average life of around 11 years. What advantages does that long-term approach give investors?
I think it's for investors that have a long-term approach to investing. I think what I've often described GCP as a bit of a supertanker. We have a portfolio of 47 investments, weighted average life of 11 years. Portfolio generates on average 8%. To change that overnight is actually quite hard. Over time the portfolio will evolve as loans repay or we sell out of assets, as we have been doing recently, and come into new assets. But it's hard to change that overnight. So I think that with that, I guess, comes a resilience in terms of the income and cash flows being generated by the portfolio. There's a natural momentum and weight there that also doesn't change overnight. Yes, there's short-term issues with specific assets, but overall, if we take the life of the assets in context, it's a resilient, stable portfolio. So I think investors benefit from that. I think it would be right to acknowledge it is a relatively long duration fixed rate instrument, notwithstanding the inflation protection that we discussed. So I think investors have to be conscious of, in a higher rate environment, there will be an impact on the relative attractiveness of GCP's cash flows. And I think we've seen that recently with the nature of the share price moving to a discount to net asset value, in part, I think, driven by the effect of being in a higher central bank rate environment.
Looking across the portfolio today, which sectors are giving you the greatest confidence?
So I think all of the portfolio is performing well. I think PFI remains a hugely stable, resilient part of the portfolio, and actually GCP's portfolio is underpinned by relatively small healthcare, leisure, education assets that are as critical today in providing services within the communities in which they operate as they ever have been. We are watching closely what happens as those projects reach the end of their life and are handed back to the local authorities, and whether in some cases there's the opportunity to extend those arrangements and continue to house those assets in a private context. I think there's huge opportunities in the decarbonisation thematic. Infrastructure has a huge role to play if we look at some of society's biggest challenges: decarbonisation, digitalisation, the growing and ageing population, so changes to our demographic. The government have mooted the reintroduction of the PFI PPP model. We think that will be focused on healthcare in the first instance. We need to invest a huge amount in defence, and that's certainly a focus. And for the first time, I think the National Infrastructure Committee published their infrastructure review that had defence as part of an infrastructure spend, which I thought was an interesting development that's probably happened and evolved over time. So But I think in terms of GCP, where we are focused on what long-dated support models exist today, it very much is focused in decarbonisation, both in core asset classes that we know well. More solar, wind, offshore wind has been a real success story in terms of deployment in the UK, but also other things. And I think the government have actually been quite creative, the previous government and this government, in introducing contract for difference models for the carbon business model, for dispatchable power, for hydrogen, for sustainable aviation fuel, that expands the available support mechanisms to some interesting areas, and GCP is really well placed to benefit from that should those sectors develop over time.